This is an overview of business assets. So talking about Chapter 12, business assets. Again, a review of what the assets are. So we talked about all assets are capital, except ordinary income assets, which are accounts receivable, creative works of art in the hands of the creator, inventory, or Section 1231, depreciable real or personal property held for the use in a trade or business or production of income greater than a year. What are the taxations? Capital gains are subject to ordinary income tax rates. Capital losses are subject to ordinary income tax rates, and they are unlimited losses if it's an ordinary income asset. Capital assets are long-term gains and losses are subject to special tax rates, and we net long-term losses, and they are limited to $3,000 per year unless they're netted. Section 1231 assets, gains are capital, and losses are ordinary. Corporations do not get favorable capital gains tax rates. But if they have losses, they may be deducted in full because there is no advantageous capital gains rate. So capital gains don't exist for corporations. Piper, a highly sought-after financial planner in her community, opened a new sales office several years ago. She purchased computers for use by her staff, and the computers were classified as 5-year class life property. Over the next 6 years, Piper and her staff used the computers, at which time they replaced the new computers. The old computers were disposed of at no value. Piper was able to recover her capital investment over the 5-year life through the depreciation deduction, which reduces ordinary income. Since she received nothing on disposition of the computer, consequently, the disposal of the computer does not trigger any tax consequences. Depreciation is a form of capital recovery. Ideally, depreciation equals actual economic decline in value of the asset. For tax purposes, depreciation follows a set of rules, regardless of actual decline in value. For example, we know a building declines using depreciation, but it might be worth even more than you purchased it for, or very likely is. When an asset is sold, depreciation is recaptured first to represent the excess of depreciation taken that is greater than an actual economic decline, if any. And then Section 1231 applies. Section 1245 is tangible personal machinery and equipment, property. Section 1250 is real property, buildings and structures. Steps to determine the tax consequences of Section 1231 assets. Categorize the asset. So is it a 1231 asset? Calculate the capital gain or loss. Consider if there's recapture. If it's personal property, it's 1245. If it's real property, it's 1250. Apply the best of both worlds rule. Depreciation is recaptured as ordinary income to the extent of any gain for 1245. So this is equipment, a vehicle, and it used to be that businesses would trade in their vehicle and they can do 1031 or like-kind exchange. And that's no longer the case, and it's not available except for on real property. So all depreciation must be recaptured before capital gains treatment applies to 1231. So what are the consequences? If the sale price equals the adjusted basis, amount realized equals adjusted basis, then there's no gain or loss, no recapture. If the amount realized is less than adjusted basis, a loss is always treated as ordinary. If the amount realized is greater than adjusted basis and gain is greater than depreciation, or gain is less than the total depreciation, then 1245 gain is treated as ordinary. If the amount realized is greater than the adjusted basis and the gain is greater than depreciation, then the amount taken as depreciation is treated as ordinary, and any excess gain is treated as 1231. What are the results? Accounting estimate of depreciation was equal to economic life. So if you did it here, then it would have been equal. If you did it here and you had a loss, then you didn't take enough depreciation is the theory. If you did it here and you had a gain but not more than depreciation, then too much depreciation was taken. And over here, it was too much depreciation and the asset appreciated. Tax consequences example. Casey wants to start some lawn mowing service. Casey purchases equipment, including a $1,500 lawnmower. He took $400 in depreciation. Casey wants to sell his lawnmower to purchase a heavy-duty piece of equipment. He can sell the old lawnmower for the adjusted basis, less than the adjusted basis, more than the adjusted basis, or more than the purchase price. So here are the examples. The amount realized is $1,100, basis is the same, no gain or loss, depreciation was perfect. The amount realized is $1,000, adjusted basis is $1,100, so that's a loss of $100. The taxpayer didn't take enough depreciation because it wasn't equal, which it usually never is, right? In example 12, the amount realized is $1,200, so there's a $100 gain. It's ordinary because depreciation, it was less than depreciation. The next one is that it was $1,700, adjusted basis was $1,100, so part of it was ordinary, the $400 in depreciation, and part of it was capital because it appreciated. So they took too much depreciation in theory, right? Because technically the asset didn't depreciate at all, and they sold it for more, so there was asset appreciation. Depreciation taken greater than straight line is recaptured at ordinary rates. If this is on real property. Unrecaptured 1250 depreciation, also known as straight line, is taxed at a flat 25%, or the marginal rate, if lower. So if your taxpayer has a rate higher, ordinary rate higher than 25, then they would tax at 25, which is advantageous, by the way. And then if they have a rate lower, they'll be just taxed at their regular rate. Excess gain is capital under 1231. So anything over depreciation is capital. An example, Lucas purchases an office building for $1 million. He's taken $300,000 in depreciation. Straight line would have been $200,000. At the time he sold it for 1.5. So first we would take the amount realized, which is the selling price here, the adjusted basis, which is the 1 million minus 300,000, so 700,000, and there's a total gain of 800,000, but we have to break it out. So how much was excess depreciation? So that's the difference between, they took 300, but straight line was 200. So 100 of the 800 is ordinary. 200 is taxed at recapture, or 25%. And the remaining amount, which is 500, is taxed at capital gains rates. We'll do more examples of this. Rules for recapture and tax planning. Gifts are depreciation recapture potentially carries over to the donee. Non-taxable exchanges, depreciation recapture carries over to the replacement property, so like-kind exchanges. And testamentary transfers, stepped up basis, eliminates or extinguishes the recapture potential. It's good news, right? If it's a charitable contribution, if the deduction is normally valued at fair market value, you must reduce the deduction by potential recapture depreciation. If it's an installment sale, including private annuities, the installment reporting provision does not apply to depreciation recapture. Recapture occurs when the gain is realized. Unrecaptured Section 1250 may need to be deferred, but all of the gain in each installment year will be taxed at 25 until straight line is recaptured completely on an installment sale. There is a 5-year look back rule related to Section 1231 netting process. Gains and losses are netted for the year. So it would be better to recognize a 1231 gain in one year and a 1231 loss in another. So a net Section 1231 gain in the current year is taxed at ordinary rates to the extent of the unrecaptured 1231 losses in the next 5 years. So example, the taxpayer had the following Section 1231 gains and losses. So in 21, a loss, in 22, a loss, in 23, a gain. So they had 14,000 in losses and 16,000. So that means that 1231 is subject to 14,000 of it because they got to take ordinary losses. They have to recapture at ordinary tax rates in 23. And the difference, the $2,000, 16 minus 14, equals net long-term capital gain. Another example of a recapture. Look back. Blanca has Section 1231 for the current year, 2023, of 15,000. In prior years, she had the following. So in 22, she had a loss. In 21, she had a loss. In 2020, no 1, 2, 3. Bianca would have to recognize 6,000 of this 15,000 as ordinary income because of the 22 and 21. And she had Section 1231 losses. The remaining 9,000 would be taxed at capital gains rates.